What's up, traders? Today we're going to talk about options. That's right. This is the one topic everybody gets confused about because it's just not explained in the most clearest terms possible. So today we're going to show you a visual look of exactly what an option does, why it works, and how you could profit from it. That's simple. So I want you to just take a break, relax, watch the video, but make sure you're attentive and you're taking notes because this is finally going to give you the clarity you want so you'll be able to start building that foundation as an options trader. All right, if that sounds good, you probably want to get more videos just like it. Of course, we have the subscription here, which all you got to do is click the subscribe, notification bell, like the comment. That's really how we're able to give you more information, more content to your phone. So you get a little notification says, boom, new video will make me a better trader. Other than that, guys, enjoy the video. Comment below if you have any questions or anything you want me to clarify. Enjoy. Welcome back to module number 5. So far, we have gone through some great content to learn about the psychological and technical aspects of the game. But today, we're going to talk about how do we leverage our money? How do we get to a point where we spend 10 times less money than everybody else, but make the same profits as the rich? Lesson 5, Power of Options. The 90% have been convinced that investing in stocks is the way to invest. And in the long term, you can really make some solid money. Although this can be true if you have a spare 100K or more to invest without ever worrying about that money, the average person with a smaller bank account has a very small chance of hitting it big. Here are the cold facts on when it comes to stock investing. Cold fact number 1. Many significant stocks sell at a $65 to $150 or even more per share. That means 100 shares of a stock at a 150 would cost $15,000. This is where the old saying, you need money to make money, comes into play. So basically, you have to risk all this cash to invest, which really turns out to be gambling anyways. Cold fact number 2. To make a big profit, it would almost take a miracle. Let's assume that you are the 10% predator and have the most powerful trading plan out there. Let's also assume you have 15K to put into the market this year that you want to turn into something big. We will also assume that you had an amazing year where you collected 120% in profits. When everything goes this way, it's unbelievable. In fact, it feels like the stars have aligned and it's time to get rich. Not so fast. Let's really break down what really happens in this scenario. So let's say we take that initial investment of $15,000 and we profit for the whole year of 120%. The total profit made on this will be $18,000. Now, is $18,000 really that much considering how much money you have in the account? And that's if you're 120% correct. Just think about that. $18,000 you make for a whole year, but you're locking in $15,000 at 120% profit. Kind of low, isn't it? What if you're part of the 90% and lose 80% of your account? Are you okay with losing $12,000? 90% would consider this a huge percentage to lose on the market. Yet the reality is, the same 90% that believe that end up experiencing a similar loss. Cold fact number 3. Many hold on to the belief that you can buy and hold the stock until it goes in the direction they want it to go. Theoretically, this is true. You can hold the stock as long as you want. There are, however, a couple scenarios with this that many don't think about when this happens. Scenario number 1. What happens if the stock never goes back to that direction or the company goes under? The biggest mistake the 90% make is thinking this will never happen to them. The cold fact here is that it happens to everyone. It's not if it will happen to you, but when. Even the best deal with this scenario. Scenario number 2. What's even more disturbing is what happens if the stock does eventually go up, but it takes a few months or even years to do it. Are you okay with having your money locked up for all that time and at best profit a couple dollars or just break even? Is it really investing at this point when we can't have access to the money that is actually losing us money at the time? Many get caught up in this cycle and get turned off to investing altogether. The 10% know how to utilize options to invest less and make substantially more. So, what exactly are stock options? Let's say you want to invest in Apple stock. What would be the exact reasons you would want to invest in Apple or any other company? Do you want to actually be a part of this company and the culture they have? Do you want to be in their investor calls and participate in everything? Maybe you just like their product so you feel like it's a great way to contribute to them. Or do you simply want to profit off of them? Well, the reality is, I might like Apple, you might like Apple, but when I put my money in there, it's not because of their culture. Do I really care about their investor calls and participate with everything? Well, I would probably go work for them. That is not why I'm putting my money in there. Do I want to support them? Yeah, I like the company and I would love to contribute, but when I'm putting my own money in there, it's simply not the way to go. What I'm here to do and what you're here to do is profit. That's all we care about is profit off Apple, profit off a company. So let's just say we have a scenario where Apple is worth $350 per share. Stocks like Apple that make you great money are that expensive. To buy 50 shares of this will cost you $17,500. And you only make $50 per dollar it moves. But why is it so expensive? The 10% secret is this. The price of admission to these stocks are a payment of all the services we talked about previously that we don't care for. We only want to pay for the profit part of it. So we use options to do so. Options are contracts that give the buyer the right, but not the obligation, to purchase a stock for a certain price at some specified future date by paying only a small option premium. We basically pay a premium to buy the stock only if it goes up at a certain time, and if it doesn't, we simply lose the premium. There's a lot to options, really is. And as you go through this, you really want to build on this because this is your chance to make money. There's a lot when it comes to the options game. We will take a look at how to do a basic option transaction. But please understand that this is something that you want to invest in learning more about to profit big with a small bank account. So let's go live and check out how options work. All right, everybody. So at this point, we understand that stocks are extremely expensive. You're paying for a large premium. So what I want to go over is what happens when we buy an option and what is the leverage of this. If you look at Apple, now this is a stock of Apple. We're going to keep it really basic right now just to kind of give you the concept of options. The stock here is worth $317.94. What that means is if you want to buy Apple, just the stock itself, and you want to buy, let's just say we'll round this up to 318, if you buy 50 shares, you're paying $15,900, which realistically is a decent amount of money. What it also means is because you bought 50 shares, every dollar it goes up, it's gonna pay you $50. So let's assume we think the stock's gonna go to $30. If we take the 30, if we take the 330 minus the 318, we get $12. So if you take those $12 and you times that by $50 that you're making for every dollar it goes up because you bought 50 shares, you're making $600. So you had to invest $16,000 basically to make $600. That is if it makes the move in the right direction. So that's how a stock works. Very expensive, small amount of money for the amount it's moving. But let's just say we say, you know what? We don't want to do this. What I want to do is have an agreement with the seller, with the owner of who's owning the stock, and tell them like this: look, I think the stock is going to move in the next 30 days to 330. And what I'm willing to do is pay you a premium to give me an agreement saying if in the next month or two this stock reaches beyond 330, what that will do is give you the ability to buy that stock only if it does what it needs to do. If not, you just pay the premium. So let's break this down. We're saying that in this scenario, we're thinking the stock's going to go to 330, and we're thinking it's going to happen in 2 months. So what you need to do, depending on your brokerage that you pick, you're going to have an option chain. There's other ways you could look it up on the internet, but I'll just give you the basics here. I use Thinkorswim myself. What that is if you type in Apple in your brokerage, you click an option chain. Everybody has them. Every brokerage should have them. And here are expiration dates. So if I think the stock's going to do something in 30 days, I might say, you know what? Let's give it 50. So if I go to 50 days, 48 days, that's July 17th. What I'm saying is I believe this stock's going to go to 330. So you see, these are called strike prices. These are the ones you want to be concerned with and really kind of look at and say, where do I think it's going to go? Wherever you think it's going to go, always go with one below that because it's going to make more money. So let's look at this. This right here on this left side, there's two lists. This is called the call side, and this is called the put side. Call is if you think that you could make money on it going up. So there's it says call, there's put. So if you think the stock's going to go up, you could go and select the call. If you think the stock is going to go down, people don't realize this, but the 10% do, you could actually make money on it going down. Same way, does not matter. Now there's explanation of why that works. We're not going to get too much into it because it's a really complex situation there, but just understand, whether the stock goes up or down, you could make the same amount of money. It doesn't matter. That's why we don't look at it as good or bad. It's bullish or bearish. Bullish when it goes up, bearish when it goes down. When you look over here, you see the purple? This means it's in the money. Anything below the price of what it's worth, remember it's worth 317, that's at 315. So what it means is if this stock starts moving up, we're making money. So let's just say if you look over here, what we want to do is we want to say, we think it's going to go to 330. So let's buy a contract at 325. So what it means is it's going to go up a certain amount of money the minute the stock starts moving. You don't necessarily have to execute a contract or wait for the contract to be up. You don't need to do that. You could actually sell the contract, which we'll talk about in a second. You could exercise your option to buy actual stock at any point. So if it goes to 335, right away you could say, yep, I want to buy the whole thing. But if you look here, let's just say we want to buy this 325 contract. It says it's worth $10. So this is the asking price. This is what it's worth, $10. If you look at the $10, what that means is if I click on $10, it's going to create an order. And basically you could buy a certain amount of contracts. We're just going to buy, in this situation, we said 50 contracts before. We'll just buy one contract. One contract means 100 shares. 100. We were talking about 50. Okay, so 50 costs us about $16,000. Now, in this scenario, we're going to buy one contract, which is equal to 100 shares. That's what we're buying it. It's an equivalent of 100 shares. What that means is it's going to cost me $10 per share. Not $3.17, $10. Think about that for a second. So if you take the 10 divided by 3.17, you're talking about 3% of the money. What it also means, there's a little number. So if I click here, confirm, it'll basically tell me here, look at this. This is telling me it's going to cost me $1,000 to make this trade. 1,000 compared to 16,000. In fact, it's actually 30,000 because this is 100 shares. Very, very interesting. So you click here. Now you see this number here? This is delta. What this shows you is how much money will move. How much profit will you make for every dollar it goes up? So if you take the 0.43, that's per share. Remember, for every contract, it's 100 shares. So that means you will take the 0.43 times 100. You will make $43 for every dollar it goes up. Every dollar it goes up. Think about that. Every dollar it goes up. So you take those same amount of dollars, which I believe was 330 minus 318. That's $12 times the 43. Guess what? You're making $516. $516 of that $1,000. Now the question is, do you have to buy that stock after? No, because what we could do is offset it. What that means is your contract is now worth more money. Okay? This $516 means your contract in your hand is worth more money. All we're going to do is sell that contract to somebody else. So the reality is this. We never buy the stock. Ever. Ever. Never happens. We literally have a piece of paper that we buy. When the stock goes our way, it's going to be worth money, and you give it to somebody else. So you literally are paying 3% of the money that you would have paid. 3%. Okay? 3% to literally make the same or even more amount. The difference is you have a time limit. So that's just the basics of options. Options is very intense. There's a lot of different strategies, okay? But I wanted to give you an idea. The idea is this. You buy a contract, you're just buying a piece of paper that is worth way less. If the stock moves up, we don't care about buying that company. We don't care. We just sell that paper that's worth a lot more to somebody else. It's that simple. It's that simple. No need to ever trade a contract. I personally never bought Apple. I trade Apple options, but I never actually owned the stock myself. I'm literally here to make money and get out as soon as I can. And the more days you get to it, obviously it's going to cost you more money. So there's a lot of reasons how we do what we do. This is just giving you basically an inside look of what options do, but there's way more to it. Okay, there's way more to it. This is just kind of give you an idea. Also, I wanted to give you a little bit of a glimpse as well. So if you look, there are other strategies that we have that literally you could be the seller. So what it means is, if you understand what I just told you, and it's going to take a little bit of time to really understand options, but that's really, you don't need a big bank account to get it. Once you really get that, there's other factors where you could say, look, and you don't have to understand how to do it right now because it's a lot of things to worry about, but let's just say, if in the next 2 months, do you think this stock is going to go to 285? Okay, if you don't think it's going to go to 285, between 285 and 275, what that means is you could actually set up something called a spread. So if the stock goes up, you're making money. If the stock stays still, you're guaranteed a premium. So you're guaranteed a certain amount of money no matter what. If the stock goes down or stays still, you're still making money as long as it never gets to 285 within a month or whatever number you give. I'm telling you this because what I'm showing you is a strategy. It's a little more complicated, but this is what professionals do. They don't chase a stock. They create something like this where they collect guaranteed premiums from people who are chasing. The 90% are chasing this stock, hoping going up or down. That's stressful. While this person's sitting over here collecting all the premium while everybody else is chasing. That's how the 10% take the 90% money. They're the ones collecting premium. They're not stressed because the reality is, statistically, this strategy has a 90% win. So it's a little more complicated. You're going to have to really understand it a little more. You're going to have to study options. What you need to understand here is the concept of how a 10% person thinks. They don't think I'm going to chase. They don't think I'm going to gamble. They're thinking how to take the people's money that are at 90%. How do we increase our chances statistically? Not luck, not news, not hope, not anything like that. Statistically is if they're wrong and the stock, let's just say we think the stock is going to go up, you got to give yourself a chance to say, you know what, I'm wrong. and it went down to 300, 295, 290. Man, I was really off. And you're still making the same amount of money because you're treating it like a business. You're collecting guaranteed premiums. So when you're sitting down and you're doing your work and you're sitting down and you're doing an investment, you want to be able to sit down, press a few buttons, the money goes right into your account for the premium, and now you just manage it. If it does go in a different direction, you could still manage on how to get out of it. If it breaks through this, there's also ways you could profit. So again, I'm not going to give you everything in one video. I know it's a little overwhelming. That's why I wanted to talk it through with you. But the bottom line is to understand this. No need to buy stocks. There's none. Once you understand options, and I do have courses where I really go into deep understanding where you'll be able to have a trading plan to understand that. Whether you do something like that or whatever you get your knowledge from, this gives you the foundation of understanding. Don't fall into the trap of simply trading stocks. Now, I know some people explain options, and options could be difficult. I don't recommend going on the YouTube or anything like that. It's just not that the information is wrong. It's very hard to understand. Get a mentor. Okay, get a mentor because it's going to be worth it. Once you understand these strategies, you'll never look at stocks the same. You're not going to stress out. You're going to be able to look at this and say, guys, you know what? I don't know why I've been doing this. I need to be able to put certain things up there that are going to give me guaranteed money with a 90% chance of winning. Okay? The 10% have a 90% chance of winning. The 90% have a 10% chance of winning. It's strictly numbers. The issue is, this is the reason, and here's why people should be asking, and they do all the time. Well, why doesn't everybody just do this? It's simple. It takes a little time to understand, number one. And if you try to watch videos all the time and they don't break things down to the right level, it's hard. That's why the ones that make money take the time to invest in themselves. Get the education on the right strategies. Practice. Put it into play. There's ways you could do where you could do paper trading where it's fake money. Do that. Trust me, it's worth it because once you get it, it may take you a month, maybe 2 months. But after that, what you're going to have is passive income. Passive income because you have a strategy that works 90% of the time, and the other 10% you know how to manage to minimize losses. I'm not saying you're going to get it right every time, but you're going to minimize enough losses and maximize the gains properly. It's all a business. It's always been a business, and you should never feel like you're fully gambling. You should be managing risk like a business. The 10% manage the risk. The 10% are the casino. The 90% are the gamblers. And the house always wins. Remember that, guys.